Can you get a 5% interest rate for a mortgage? I was on a call recently with another investor, James Daynard from BiggerPockets on the market, and he said he's been hearing of people getting rates in the 4%. These are with small local lenders that they already had an established relationship with, but I still couldn't believe it. The reason was because they weren't just seeking lending from the bank. They were offering the bank their deposits. That's what banks want. They want to hold your deposits. If you have any kind of savings or large deposits coming in, even if they are paid out right away, those are attractive to the bank to want your business. Small local banks have more flexibility to manipulate your interest rate because you can usually speak with the person directly that's in charge of making that decision. Large national banks, not so much unless you are a huge client. Most likely, you are not watching this video if you have millions of dollars with Chase Bank. If you do, then you should totally be leveraging your deposits with them for lower rates or moving to a smaller local bank that will give you those low rates. I'm Ashley Kerr, co-host of the Real Estate Rookie podcast and author of Real Estate Rookie. After I had this discussion with the other investor, I did some research into how investors, especially rookies, could get lower rates. Maybe not 4%, but 5% actually does seem really achievable right now. Today, I am going to show you how. Before we get into 5 ways that rookie investors can get 5% interest rates, let's hear a word from our show sponsor. I've talked to hundreds of pro investors and they all automate to scale. If you're losing way too much time on busy work, then I need to tell you about Baselane, a trusted BiggerPockets pro partner. Pro investors use Baselane's banking and AI-powered bookkeeping platform to organize their rental financials, automate rent collection, and auto-tag transactions in real time, giving you instant cash flow insights and reporting without any admin. Also, check out Baselane's other features like recurring payments, multi-user access, and free wires to save you more time and money. Invest smarter, not harder. Click the link for your $100 bonus at baselane.com/BP. That's baselane.com/BP, as in BiggerPockets. Before we get into it, I want to ask you to subscribe to our channel if you like these videos. We put out a new video every Monday, Wednesday, and Friday with the occasional Tuesday or Thursday release. We love to create downloadables for rookie investors to use during their journey. You can find them all at biggerpockets.com/rookie resource to download for free. I started my research with looking at current rates and where they're at. I went to the website of my small local bank. This bank has around 8 branches, so very small. They are the bank that once gave me a 90-day unsecured loan to purchase a property, then had me come back and refinance with them for long-term debt after I closed on the property. The loan officer was able to get really creative to help me get that deal done. So right away, looking at this chart, you can see that today, if I locked in my rate with the bank, I could get a 15-year term loan for 5.875%. Let's take a look at how this differs from getting a 30-year loan. Let's use a $250,000 loan as an example. Usually I always use $100,000 for easy math on my part, but I'll go ahead and use a more realistic number if you are buying in my market. Your monthly payment would be $2,092 without escrow, so no taxes or insurance included in that payment. If you had the same rate of 5.875% for 30 years, then your payment would be $1,478. That's $614 more you would pay a month amortizing the loan over 15 years instead of 30 years. Now let's compare that to the 30-year rate they had listed, which was 6.625%. The monthly payment would be $1,600. This is a $122 difference a month from an interest rate at 5.875% amortized over 30 years and 6.625% over 30 years. This option is $400 less a month than the 15-year loan. Here are some things you need to consider when determining if you should do a 15, 20, or 30-year amortization. These are the standard amortizations for residential loans. First, how long do you plan to own the home? Do you plan to sell it in 2 years so you can get those tax-free gains from the profit of the sale? If you look at the amount paid in interest over 2 years, it will not be that much to make a huge difference if you are talking a 1% difference in interest rate. But who doesn't want to have another $122 in their pocket by having a lower rate? So let's figure out some tactics and strategies for getting a 5% interest rate with a 30-year amortization. The first option is paying points, buying down your rate. As rates are already getting lower, then it is cheaper to buy down your rate. Points equal prepaid interest. You're basically giving the lender some extra cash upfront in exchange for a lower interest rate over the life of the loan. 1 point typically equals 1% of the loan amount that you are borrowing. So let's say you're borrowing $200,000. 1 point would cost you $2,000. In return, your interest rate might drop by, say, 0.25%. The benefit? That lower rate means lower monthly payments and potentially thousands saved in interest over time. But it only makes sense if you're holding on to the property long enough for those savings to outweigh what you paid upfront. So here's a quick cheat sheet. This is a good move if you're holding the property for the long haul. Compare the cost of the point you're paying and how much you would actually save over time. It may be not worth it if you plan to refinance, sell, or do something creative in a few years. And always do the math or ask your lender to help you break it down. I look at points like this. It's a tool in your investor toolbox. Not always necessary, but good to understand when you're locking in financing on a long-term hold. It's not mandatory, but it's a lever you can pull. Just make sure it aligns with your strategy and timeline. Another tool in your toolbox are seller concessions. It's actually one of those sneaky, powerful tools you can use to make a deal way more affordable. Here's the deal. Seller concessions are when the seller agrees to cover some of your closing costs. It's kind of like the seller giving you a rebate or credit to help you close the deal. This could include things like title fees, appraisal costs, transfer taxes, loan origination fees, and even buying down your interest rate to 5%, aka paying points. Let's say you're buying a $250,000 property and your closing costs come out to about $7,500. You negotiate $5,000 in seller concessions. That means the seller agrees to cover $5,000 of your closing costs and you only have to bring $2,500 to the table instead of the full $7,500. That's cash saved upfront, which can go towards renovations, reserves, or your next deal. This matters to a new investor because it helps you preserve capital, which is everything if you're trying to scale. It also makes it easier to get into your deals without draining your cash. It gives you negotiating power, especially in a buyer's market or if the seller is really motivated. Just keep in mind there are limits based on your loan type. Lenders will cap how much the seller can contribute. It's usually a percentage of the purchase price. So here's a tip. If you're offering close to full asking price or even over, you can sometimes bake the concessions into the offer. The seller gets their number they want and you get help with closing costs. It's a win-win. But just remember, there are limitations. So you don't want to go in thinking you're going to get everything covered. So it depends on the purchase price and the loan product. So talk to your loan officer. Part of this is being able to negotiate with the seller. Are we in a buyer's market where this is more feasible? According to an article by CNN, Rochester, New York, Buffalo, New York, and Hartford, Connecticut all have 1 month supply and are still strongly favoring home sellers as of this past February. Other parts of the country are starting to shift to a buyer's market. Existing home inventory was up by 5.1% from February. We are hitting the spring market and there are usually an uptick in home listings anyways, but it is up 17% from last year at this time. With an increase in inventory, this could be an opportunity for sellers to negotiate due to more options available for home buyers. We are also in this area where interest rates are not considered low yet, so there are still buyers holding out and waiting. This graph shows active listings. As you can see, there was a big uptick during the fall of 2024 when rates did drop for a little while. Also, this could be a lot of people wanting to sell before the winter market hit. The next release of this data is April 3rd to see how inventory has changed for March. You can find this chart and other information at fred.stlouisfed.org. Okay, so let's do a quick recap outside of the data and metrics. How can you get a 5% interest rate? The first thing we went over is negotiating with a small local bank that you will give them deposits. If you are doing any construction loans or rehab loans where you get draws from, you can tell the bank you will deposit those chunks of money with them, even if you are basically spending it right away by paying contractors. If you have lines of credits that you use to fund properties or rehabs, those big deposits from the line of credit to the bank account could be enticing to the bank. The second one was shortening the amortization period of your loan, considering a loan that is less than 30 years. The third option was paying points to buy down your rate. When rates were at 8%, this was really expensive to do to get down to 5%. Number 4, using seller concessions to pay for the rate buy down. They're giving you a credit which you can use to pay for the points to pay down your rate. Number 5, we haven't talked about yet, a variable rate loan. I pulled the current rate for a 7-year ARM. A 7-year ARM, or in this case, my example, a 7/6 ARM, is a type of mortgage where the interest rate stays fixed for the first 7 years, and then it adjusts once every 6 months after that. The 7 in this scenario equals how long the rate is fixed. The 6 equals how often it can change after that. So our example is the interest rate will change every 6 months after those 7 years are up. Once those 7 years are up, the interest rate can go up or down every year or 6 months based on the market and your loan's terms. There's usually a cap on how much the rate can increase annually. There's also a lifetime cap, so it doesn't go totally wild. So it's not a total mystery, but yes, the rate can go up after the fixed period ends. In my example, the rate is 6% from this bank, which is not the 5% I promised you, but you can use one of the other tactics to buy it down to a 5%. This is also just one bank. Shop around for rates. Email and call local banks to ask what their current rates are. They will probably give you a spiel that this isn't guaranteeing what your rate will be, since you most likely won't rate lock right then and there, but it gives you the opportunity to compare rates with other banks. Of course, this will depend on your credit score, debt to income, and other factors, what your rate is, but it's a starting point to see which bank has the most competitive rate. If you decide to use an adjustable rate mortgage loan, you should consider some factors first. This is a great plan if you want to sell your property before the 5, 7, or 10 years are up. If you are doing a live and flip or selling your property in 2 years for tax-free gains, this is a great option. If you plan to hold this property forever, it is very unknown what rates could be. I have done one of these in the past, and the max rate it could go up to was 10.5%. My rate they gave me for the 7 years was 5.275%, which if I wouldn't have done this, it would have been more like 7%. If I kept that up as a rental and my rate shot up that high, it would absolutely kill my cash flow. I only recommend these loans if you plan to sell in the future and you give yourself enough time to sell the property. Because what if it doesn't sell and it just sits? You also want to prepare to refinance at some point if you do decide to keep the property. So we've gone over 5 tactics to use to secure a 5% interest rate on your property. This is much more achievable if it is your primary residence rather than just an investment property. Once again, house hacking comes out on top with the easiest way to get started because of the better financing terms. If you have other ways to get 5% mortgage rates, please add them below. I'd love to hear them, and I'm sure everyone else would too. I'm Ashley Kerr, and thank you for joining me on the Real Estate Rookie YouTube channel. If you're not already signed up for our rookie newsletter, head over to biggerpockets.com/newsletter and sign up. We go over headlines, trending data, and also tactics specifically for rookie investors each week. Thank you so much for watching.